Hello and welcome to IREI Live, Future of Logistics and Retail. My name is Loretta Clodfelter. I'm Senior Editor of Institutional Real Estate Americas, and I will be your host and moderator today as we dive into the future of logistics and retail. First of all, we would like to thank our sponsors for making this webinar possible: Clarion Partners, Elian, Equus Capital Partners, Hines, Prologis, and TA Realty. And it sounds like I'm having a little trouble with my sound. Okay.
You're good, Loretta.
Okay, thank you. Should I start from the beginning, or have we been clear throughout?
It's been clear throughout.
Okay. In the third quarter, e-commerce retail sales in the United States were nearly $215 billion, representing 13% of total sales. This is a significant part of the overall retail landscape, and the rise of e-commerce has provided headwinds for the retail property market and tailwinds for the industrial property market. In our first panel, we will cover macro trends affecting both retail and logistics. And then in the second and third panels, we will focus on retail and then logistics property in detail. I want to encourage our audience to also participate in this conversation by using the Q&A button down at the bottom to submit questions, and I will pose those to the panelists as we go on. To get started, though, I'd like to begin our macro retail and logistics trends panel, and I'd like to welcome Melinda, Jim, Maria, and Kyle to the virtual stage, and we can go ahead and get started. Great, thank you. I'm going to go around and maybe we can do some quick introductions and then we'll get started. So let's kick things off with Kyle. I'm having trouble hearing you, Kyle. So maybe Jim, you can do your intro while.
Sure. I'm Jim Mercedes. I'm one of the managing partners of TA Realty. I've been with TA for 25 years. I lead the strategic direction of our various products and our portfolio management teams, including our logistics-only open-ended fund. In logistics, TA has invested over $11 billion in over 30 years across the entire U.S. and the entire risk spectrum, everything from core all the way through development.
All right, and can we hear Kyle now? I just want to test that.
Hopefully I'm back.
Yes.
Hear me now? Perfect.
Yes.
Thank you. So good afternoon and good morning to some. Kyle Turner with Equus Capital Partners. I'm a partner director of investments and oversee our investment activities across the United States.
And Melinda?
Hi, I'm Melinda McLaughlin, Global Head of Research for Prologis. Obviously, we're the largest vertically integrated operator of logistics real estate, managing over 1 billion square feet across 4 continents and 9 countries. Active, similar to Jim, everything from core through development. And for Prologis Research specifically, we're focused on understanding the structural trends in supply chains and logistics real estate and use Prologis's global platform, data, customer relationships, and extensive local expertise to do that.
And Maria.
Hello, everyone. Maria Serena. I'm a senior director on the real assets team at Cambridge Associates. I started my career actually in the grocery anchored acquisitions and portfolio management. So I'm certainly very biased in favor of the sector. But in my current role on the investment advisory side, I can assure you all I take many more meetings on the industrial and logistics oriented strategies than I do on the retail. So I'm very excited to be on the panel and discuss what's going on in the 2 sectors nowadays.
Let's kick things off by talking a little bit about how retail and logistics have evolved over the past 20 years. And I'm going to start things off with you, Melinda. Maybe you can kind of talk a little bit about your perspective on that.
Absolutely. So something, of course, we've been studying, a few big themes we've uncovered. Logistics has definitely moved from a line item in the budget to something that is crucial for revenue generation and cost control. We see more customers coming to the table with a holistic view and making decisions in that way, where logistics plays a part, certainly to getting goods to customers on times, but also to controlling things like transportation costs and risks. Additionally, we see these global best practices spreading. So the US is one of the most mature logistics markets, and we definitely see those patterns and practices spreading throughout the world. And finally, in the investment environment, it's certainly been a story of institutional consolidation of what was previously a more fragmented and less kind of mature investment profile in the past.
I'm going to go over to Maria. Do you have anything to add to that sort of overview?
I'll just maybe share a couple of data points here. I looked at the composition of the Odyssey Index, and I noticed, not a surprise, that today retail sector represents maybe 13% of the index. It used to be 20 just 5 years ago. On the opposite side, industrial is now a quarter, like 26% or something like that. And it used to be maybe 13, maybe less than that, just 5 years ago. So certainly the balance has shifted, and it's not just, I guess, the supply demand dynamics. It's obviously the reflection of the values as well for both sectors. And there's so many more trends. Look at the top performers versus bottom performers in the Odyssey, and you'll see who has more retail versus industrial. It's also sort of indicative.
And Kyle, do you have a little bit more to add on this?
Yeah, to really keep it simple, it's what's evolved is the way and manner in which people access goods and services. And that's both industrial and retail. You're looking for a more experiential, way of life on the retail side. And then, an entire industry has evolved relatively recently in, due to e-commerce. And that's not just with goods, but that's food and groceries on a daily basis that have really opened up an entire demographic that was not participating in that sector prior to the pandemic.
And Jim, I know it feels like everyone's said everything that can be said, but maybe you can talk a little bit about this and maybe some of the main drivers of these trends.
I'll add a little. I mean, obviously, changes in consumption patterns has changed industrial for sure, right? Specifically e-commerce, and the expectation of faster delivery has completely changed the game. So for that, you need more modern facilities or upgraded older facilities that can effectively move the product in the most efficient manner. You also need a wider footprint, including a lot of infill locations closer to the demographic to cut those travel times, but also, as Melinda mentioned, to cut that cost associated with that. So specific to today, I think that increase in retail sales in general, and then obviously supply bottlenecks has amplified all these issues with regards to logistical supply chain and the building out of the supply chain over time. So, it's not just about clear height anymore. It's about floors, it's about doors, it's about how you move this product inside these buildings. I know it's strange to say, but super flat floors to help with automation and moving the product inside of these buildings is critical. And I think that, maybe the most important is the number of doors. And when we first were looking at these buildings, it was, one door per 15,000 square feet and one per 12, one per 10. That went away pretty quickly. Now it's one per 5. We even built a building recently that's one per 3,000 square feet. The reason is the product is sitting in these buildings for less and less time and moving at an extremely fast pace. And so throughput, being able to meet the needs of today's logistical supply chains users and to build the modern facilities to accommodate that is very important.
Yeah, I see all of you sort of nodding along. Anybody else want to add a comment here? Melinda?
No, I mean, I think if we're going to pivot to building design, it's certainly a story of functionality on one hand, but definitely a story of the right locations. And I think that's evolved and something that, structurally isn't going back. One thing, Kyle hit on, the way people consume has changed in a structural way. But I also think it's about the amount of competition in the retail space with all these new ways to reach consumers digitally, to use data to your advantage. Customers are also looking at the supply chain and saying, how can we eke out a competitive advantage there? And certainly having the best facilities in the best locations is a way to do that. And we've had obviously leaders in the space, especially e-commerce, continually raise the bar. And once you set that standard for consumers, there's no going back. So everyone is, following behind.
And what are some of the main drivers of these trends? I think Jim touched on a little bit, Melinda as well, but maybe Maria, maybe you could talk a little bit about some of the drivers behind these.
I think I probably won't say anything that we don't know already. It's the consumer preference have evolved, and that just impacted the way industrial distribution is set up. But I want to give a credit, I think, to the retail industry. They had to adapt and evolve, and maybe COVID, that's a silver lining of that it sort of forced them to offer curbside pickups and to figure out the way to reach out to consumers when you can have to basically stay shut throughout the vulnerable, COVID early months. So consumer preferences, I know Jim mentioned the supply chain disruption. That I think is certainly additional driver, maybe more so for industrial, right? Trying to find out extra space to stock up inventories. You never know what's going to happen, and the next container or ship is going to get stuck in some port waiting to be offloaded. So yeah, I think consumer preferences, COVID on itself became a big event. In the US, millennials are starting to form households, then that impacts, I think, big time where they want to live, and that helps retail sales, but it also impacts, again, the need for more wide distribution across the country.
Maria makes a great point. I mean, there's really three legs to the stool, the demand side here, which is really the dominant feature of this increase in activity, right? So one is e-commerce, two is the inventory rebuild, and the third is general GDP. Right. So the e-commerce component of the demand is, as the online sales, consumer spending penetration continues to increase, and obviously a lot of that was pulled forward through COVID, there's a direct correlation to the need for industrial space in the marketplace. So the correlation is for every $1 billion of additional online sales, it translates to a need in the logistical supply chain of another 1 million square feet built. So for every billion's another 1 million square feet. So you can see that it's not just the rate of change of e-commerce sales, it's directly correlated to the need for growth in buildings. The second one that Maria mentioned, which has been something of a little bit of a surprise, was the fragility of the supply chain. And this just-in-time delivery, 20 years of narrowing down the inventories in order to have corporate balance sheets benefit from it, and they did, has created a pretty fragile logistical supply chain. And so this inventory rebuild is really adding to a lot of the demand. And it's expected that if inventories increase even 5%, it's equal to probably about 400 to 500 million square feet of new buildings that are needed in the supply chain. So this is important, right? And and things like ships getting stuck in the Suez Canal, and that might sound simple, but that was prevented $100 billion worth of trade from coming through the canal per day, and it happened for 6 days. So that's $600 billion of interrupted trade. So these things are all really starting to continue to push what everybody feels might be a pretty accelerated industrial market and a lot of activity that's occurred, but there's still more e-commerce demand to come. There's still more inventory rebuild, and then obviously GDP growth on top of that.
Yeah, I think I think we all remember the China Evergrande getting stuck in it's the Evergreen coming from China. Kyle, do you have additional thoughts on this?
Yeah, I'll mirror what Jim said. I think what Jim said hit the nail on the head. But if you look at us all individually as consumers, there's really three things that are driving our behavior, and it's convenience, it's quality of life, and it's time management of how we are sourcing the goods and services that are really driving what Jim outlined. And we can all see that, where I do not like going to the grocery store. I do not like going to a mall. But I can do the same thing from, sitting at a red light on my drive home from work and having, that same product at my doorstep when I get there. And that allows me more time with my kids, more time to work out, more time to spend doing work. So it allows you to plan and become a little bit more efficient throughout the course of your day.
Absolutely. Melinda, I want to ask you, how has COVID-19 affected these retail and logistics trends?
Well, I think it's just accelerated trends that were already at work. So let's talk about the supply chain resilience factor, certainly in front of mind now. I hope everyone got their Christmas gifts or holiday gifts early. That was something that may seem new because of COVID, but we had actually already seen with some of the increased trade tensions, either Brexit or the US-China tariffs. Immediately after those changes were announced or implemented, it was a huge year for logistics demand. So you can see customers working to build up inventories inside a country's borders and reduce their exposure to either difficulties getting goods in and out or potential price changes. So that resilience was already starting to take hold. My team actually just released a paper that looked at some of these mega trends where, yes, COVID was the disruption of our times, and hopefully that doesn't happen again. But we are seeing increased severe weather events. We have a labor shortage going on in the US and negotiations coming up at key ports next year. There are, geopolitical factors, and geopolitical risk is rising in a structural way. So the idea that once COVID goes away, the need for resilience goes away, I think is patently false, because looking forward, anyone who's been planning even prior to the pandemic is seeing an environment where risks are just more a part of business, and the cost of not being able to use your resources and get around those risks and get your goods into your customers' hands are huge. So even though it may cost a little bit more to hold some extra inventory, the lost revenues from not having those goods in stock, and then the potential, customer dissatisfaction and loss of a customer, really compounds that. And I think it all goes back to and ties in with retail, how competitive this environment has gotten, how Darwinian, how much, you need to look at each tool in your tool chest and really try to be very strategic about the way you're setting up your supply chains, your retail networks, and the way you're reaching your ultimate customer.
Yeah. Maria, do you have something to add here?
Sure, I just actually came to my mind this song, I think, that what doesn't break us make us stronger. I think with some of the retailers, that's exactly what COVID has created. That yes, it was certainly accelerating the inevitable, decline of some tertiary and maybe overbuilt retail in some markets. But for the ones that figured it out, I mentioned now almost 50% of the survivors offer this curbside pickup option, right? The online grocery that was sort of untouched by e-commerce, meaning prior to COVID, it was 3%. And now it's 12.5% of all the grocery sales are done through whatever Amazon or Instacart and other options, DoorDash and Ubers. And now they're saying it's going to be 20% in just in a few years. So certainly a lot of adoption, a lot of innovation that otherwise would have to wait for years to come. So I think that's very exciting. And I know, Loretta, in your opening remarks, you mentioned just the volume of retail sale. It's certainly coming back. It's 30% up from where we were at the COVID, at the trough of the situation. And foot traffic is up. So I think we see some signs of recovery, and we see a lot of innovation that is welcome for the sector.
And I just want to remind our audiences that we are accepting questions, so you can submit them through our Q&A button. One of the questions I just got coming in, what kind of lessons learned can you disclose given the quick acceleration of trends and the quick adaptation by the industry? And I'm gonna start with you, Kyle, on lessons learned, but I'll go around to everyone.
Lessons learned, that's a great question, because I don't think many have been able to make mistakes in our sector over the last couple of years. I'd say the biggest lesson learned from us as we build out our future development pipeline really is having having more optionality on our land holdings. And that's where, we've sold some land that, within a fund structure wasn't I guess documented the right way for speculative development, and having the flexibility within the operational controls of whether a programmatic joint venture or a fund to take advantage on a speculative basis they may not have been there otherwise. So I'd say that's the biggest lesson learned for us, is to making sure that we can encapsulate risk in the right way across our entire, all of our verticals across the business.
Tim, lessons learned?
Lesson learned is to think like the end user and not like an investor. And since either the physical aspects and attributes of these buildings has changed in order to meet their needs, or other things such as labor, when we look at investing in these buildings, we have to kind of view it through their lens of what their expectations are. And so, it's interesting that a lot of, like Kyle said, it's hard to make some mistakes, but mistakes can be made. And just because a industrial building is older and close into the city and the demographic doesn't mean it's functionally appropriate for the needs today. But what we've been doing is actually doing labor studies in the surrounds of where we're investing in order to understand the depth of available labor, commute times even, and also average wage, because one of the problems of these users, because of the higher density of workers in these e-commerce buildings, is actually getting the to be able to work in the building. And interestingly enough, it's not necessarily a pure cost issue. It's actually a pretty small component of the total cost of the facility. Labor costs are somewhere in the 3 to 5% range of total cost of these facilities. And so it's, they're kind of insensitive to the cost, but availability is really the big problem. And so understanding and looking at it the way they do with labor studies, et cetera, is incredibly important.
Jim, that's a great point. I'd just say for everyone in the audience to take note, I mean, Melinda brought up a great point with the union negotiations that will occur next year. Look at what's happening in Savannah, Charleston, Norfolk, Houston, from a net absorption perspective, is, setting records in all 4 of those markets. And I think that's a direct effect of Melinda's prior point and Jim's on labor being a huge piece of the, upward growth in this sector.
Yeah, Melinda, additional lessons learned?
Well, I think I definitely echo that. We've been doing labor studies for a while, and it's been a big issue. I think that the initial reaction during COVID was unemployment's going up and it's going to get easier, and it got way, way harder. So it's even more difficult today. But I think one of the things that really we've been learning is how regulatory resistance to logistics real estate has really accelerated in this environment as well. We all want our goods, we all want them next day and 2 day, but no one wants to live next to a logistics facility. And understanding, obviously the way land use has evolved and the way you can still secure and make sure your city functions. I think COVID really proved out how essential this e-commerce delivery service is to all of us. But 2, there are ways to adapt facilities so that they are better neighbors, obviously incorporating things like EV charging, doing traffic impact studies, things like that. We're really trying to understand, especially in these urban areas where customers need the most, they're still very under penetrated in these areas as far as getting those last mile, last touch facilities, of course, especially close to end consumers, where there's the fewest properties, there's no land, there's very few properties for redevelopment. There's a ton of resistance, either from the government or the local communities. It is a very challenging endeavor, but what we're hearing is our customers need more and more of that type. So yes, you can continue to go out from city centers and probably make things work, but to really get facilities online in the places where they need to be, that has become increasingly more challenging over time. And really understanding that, I think, will be crucial to helping these supply chains kind of evolve and be really future-proof.
So you have consumers saying, I want my goods immediately, same day delivery, but I don't want to live next to a warehouse. Is that sort of the problem?
Pretty much. And, most people who make these land use decisions would prefer another property type. However, as we've all been talking about, the demand side is really overwhelming here, not just for last mile, last touch, the whole e-commerce, but for supply chain resilience. So the lack of logistics space around key trade gateways is a key crucial part of why we're experiencing some of these challenges. It's not the only part, but it is a part. And so when we think about avoiding a situation like this in the future, allowing more logistics space in the places where it needs to be built, and whether that means going vertical, whether that means, really creative public-private partnerships, I think that there's a lot of opportunity here, but it does require, I think, a more open mind.
I want to dig in a little bit on the question of valuations. This has been kind of a big question, a hot topic over the last year. Are logistics assets overvalued? Are retail assets undervalued? Or is there a little bit more nuance to the situation? And I'm gonna start with Kyle, but I'll give everyone a chance to answer in turn.
Obviously, a great question. You hit the nail on the head with the question that's a bit nuanced. Is where do you view each asset class on that risk return continuum? There's some structural issues in the retail sector that we've touched on. I think there's a little bit of a point of reinvention in that sector that's ongoing, and you're at a point of demand that's never been seen before in the industrial sector. So, acquiring assets at a 4 cap when you have upwards of 25 to 30% mark-to-market opportunity feels like a very appropriate yield on cost that gets you to, close to where you're getting new development yield today. And that's, in that 6 to 6.25 it feels very frothy. And it sounds kind of weird to say it like that, but that's a better position for, in my opinion, to place capital than in the retail sector, where you see grocery anchored product trading in the 5.5 range, stabilized yield on cost in the 6 range. So you're really solving to the same number. It's just what's the structural risk to that same level of return. And I think right now the more risk appropriate is industrial.
Jim?
I agree for sure. Look, trees don't grow to the sky, and so valuations for industrial can't just keep going and going. But IRRs, cap rates, spreads over treasuries are all still within appropriate norms. Debt is still accretive to even these low cap rates, but I think it's these low cap rates that start to get people uncomfortable, right? But cap rates, people have to remember, is it's not just a return, it's an indicator of your ability to change income over time, right? And so that gets to what Kyle was talking about, is it's just an indicator of the rate of change of the income side and the potential for total return. And so, yes, 3 caps, and even in LA and in New Jersey, sub 3 caps may sound incredibly unsettling, but it's all about the potential to either mark to market and to have rent growth over time to be able to increase that income stream in order to achieve your total return goals.
Melinda?
Well, I think you probably know my view, but to pile on this, one thing I really try to think about is, what is the norm? Jim said they're all the spreads within historical norms, but is that really an appropriate view going forward? And there's a couple, again, structural themes that I see could potentially keep the cap rate spread for logistics lower for longer. One, liquidity in the sector has increased in a structural way. There are so many more institutional investors active in the space that liquidity risk premium has definitely come down over time. And the second is supply risk. We are at a point now where vacancy has never been this low. Certainly it's due to demand side, but like I just talked about, the regulatory environment has shifted. The lack of land available for logistics real estate has definitely decreased. And it's something that I see in the past. You definitely wanted to make sure you're compensated for that real estate risk and the risk from new supply. I think it's changed in a structural way going forward. And to Kyle's point, that whole risk return profile has morphed. So when we think about the future, I would say cap rates definitely, or the spread at least, lower for longer. And looking back over the past isn't necessarily indicative of where it could be in the future. But I think you do have to be really careful about locations, because there are some places where you can get land, you can entitle it, and you can put up a building. And I do see a risk in treating kind of any logistics real estate equally. So I would also be really strategic on your location selection as well.
And Maria, you've heard 3 strong, compelling industrial pitches just now.
No, I mean, finding value is the question of the day, right? And if the favorite sectors reach out the pricing that kind of force you to lower your return expectations going forward, you need to look elsewhere. And just as Melinda said, you have to think about location for any industrial building. I think with retail, it's nuanced to the level of the asset and its tenancy, and it's not just the market itself. It's the really to the investment level that you need to make a call. Is that a retail shopping center is going to create some outperformance for you? So, I mean, we all lived through COVID. To answer your early question about the lessons learned, my personal lesson was stock the essentials. But that joke aside, besides stocking the essentials, obviously grocery anchored retail has performed strongly through COVID, and that reflects in its pricing. And we expect the cap rates for that grocery anchored in particular necessity type of retail will be compressing because I think people sort of believe and it's easier to underwrite those long-term leases for the grocery anchor, especially if they perform well. Now, vaccine rollout happened shopping centers, especially the ones in prime locations and the ones with, maybe open air concept of some sort that can allow some of that social distancing to the degree. So I don't want to say like rents will go up and retail is great, but I do think there is ability to find value, whether that's attractive, cash yield, or, if you're experienced investor and you can take on the risk and reposition this, C-class shopping mall and add some, mixed use or just spice up the tenant mix, add more experiential, add some healthcare, office, medical buildings. I think there is certainly on a higher risk return profile, you can still play in the retail sector. So that's my view. I don't disagree with my 3 other panelists, but I think that retail certainly has more one-off opportunities as well going forward.
How do you, and here's another question from the audience, which I think is a great one. How do you evaluate the impacts of inflation on retail and logistics? The consumer price index, I think it just came in at 6.8% on a year-over-year basis. Like that's probably the most significant inflation we've had, at least in my career. I'm gonna maybe start with you, Melinda. What are your thoughts on inflation and its impact here?
Well, it's definitely something we're looking at from a ton of angles. One is, our customers, the people that lease space. And one thing I would say is an offsetting factor is they're saying they've never had more pricing power. So the old pattern of maybe overbuying and then discounting is something that is just not happening today because of the supply chain challenges. And so margins are actually quite healthy. So let's, continue to watch, obviously, consumer spending power and wages and how it all evolves. But from the customer perspective, at least right now, it seems like their businesses are doing fine. And, they're able to pass a lot through to end consumers. So then, on the real estate side, how might it impact rent growth? Well, what we see on the ground is replacement costs have moved dramatically over the past couple of years. So we estimate more than 25% in the past 2 years alone, and probably more than 15% in just 2021 alone. Now, there's a wide spread depending on which market you're in. Basically, the land component, I think, will be the primary driver behind there. But even beyond that, materials are subject to the same supply chain bottlenecks as everything else. And it's been really difficult to secure them. Pricing is obviously moved for steel, for lumber, for concrete. And we see a lot more delays. So it's taking longer than ever to bring a building online. And then you have the labor component, which, has been touched on in a number of different ways, but wages are going up. It's difficult to find people, and those do tend to be sticky. So that will ultimately add a lot of uplift going forward to rent growth, given how replacement costs have moved. So even in your outlying areas where there might be more supply, developers have to charge a higher rent just to keep up with costs. And finally, logistics pro and con of having slightly shorter lease terms than something like office. Yes, lease terms, I will say, first of all, have been increasing in the structural way. All the things all my wonderful panelists have already said about this being strategic, customers making these long-term decisions, definitely flowing in. And so we do see average lease term creeping up. But that said, you're probably on average going to have the opportunity to reset at least every 3 to 5 years. And in certain geographies, we have CPI linked leases, mark to market in the UK periodically. So there are a lot of ways in which a logistics real estate income stream is definitely shielded from this impact. And with the benefit we are with historical vacancy and the rent pressure and the demand side pressure that we have today, I think we're feeling okay, but it's a risk worth monitoring.
Jim?
Linda said it perfect. I don't have too much to add except from maybe an investor perspective. How do you approach everything she just laid out there? It's rollover or vacancy is good for now, right? And so with these, incredibly quickly moving rents and the ability to get to a mark to market in order to increase your income return and value, shorter duration leases or multi-tenant where you have the opportunity to change that income stream as quickly as you can is important. I know that, long duration leases and core buildings with long leases do have a home in portfolios, and they do, give you risk adjusting, components and have all of those items that Melinda was talking about with either stated bumps or some form of mark to markets or CPI linked increases. But, if inflation increases, that could affect rates or cap rates, which could mean that you have duration risk and maybe valuation concerns, with very long live leases. So I think that we're, specifically kind of guiding ourselves, at least on new purchases, to deals that have shorter duration where we can access mark to market for income change.
Kyle?
Again, both Melinda and Jim said it very well. And to piggyback Jim's last point of, really where our focus has been shorter duration, multi-tenant assets in difficult to replicate environments. So higher barrier to entry locations that give you near-term visibility on business plan execution for that mark to market. And it's a little bit of a fine line to walk where what is that right duration that you want to not only sell, but also gives you the access to maximize return for investors that we're paying very, very close attention to right now, because rents are moving at such a rapid pace that in many instances, and I'm sure, everybody listening has seen this in their portfolio, that, we've been able to execute, 4 and 5% interim rent bumps as kind of a risk mitigant offset to rising rental rates if we are locking in a longer term lease.
And how are tenants responding to these rent increases, Kyle?
More often than not, their business is in a very favorable position, so they're doing very well. It's a tough pill to swallow for them, but at the same time, there's very little option. There's nowhere else for them to go. And it is very much a landlord-driven market right now that you can, in some markets, name your price, and they don't have many other alternatives.
Oh,
it's
Maria.
It's a fraction of the transportation costs. It's a fraction of the inventory costs and everything else. And so, rents are growing very high, and the question is, how much can you push these tenants before they break? And again, it's a small component, 5% or so of the total cost of the facility. And so they have room to absorb these higher rents in order to achieve their goals of their logistical supply chain needs. So it's actually some pretty powerful landlord pricing power here in order to, continue on with this income growth.
Business interruption costs and moving costs are extremely high as well right now, at an all-time high. So to add on to the other costs that Jim mentioned, that you're kind of hitting them up from all angles, that it's very cost prohibitive to even move.
I think when we talk about this inflation, when we talk about the issues of inflation, one of the things that comes up is, can real estate serve as an inflation hedge, in fact? And I think, Maria, I want to ask you, when you're advising and talking with clients, do they ask you about inflation, and how do you sort of think about these? How do you think these things through when you're working with investors?
Yeah, that's a great question. I think historically real assets have been perceived as a perfect inflation hedge. Turned out it's not a perfect inflation hedge, but it's still a hedge, right? And one of the roles in portfolio for real assets continues to be inflation hedge, exactly for the contractual obligations and the ability to drive up rents. So I think that right now, when we're in the inflationary environment, again, when clients ask about real assets and the role in portfolio, inflation hedge becomes an additional factor to include real assets in the portfolio, because maybe relative to other assets that can be creating portfolios for our clients, it's an additional bonus. So yeah, certainly recognized. And I haven't seen many industrial leases that do have the CPI adjustment, but if that exists still, that's even better.
And do you want to talk anything about inflation and the retail property side? Have you seen anything to be aware of on that front either?
I haven't seen as much. I would just say that, again, going back to the grocery anchor type of retail, the sales were so strong that the percentage clauses kicked in for some of the shopping centers and landlords. So there was kind of additional just revenue stream, but sort of driven by just the overall volume, and I guess pricing is part of that equation, higher price.
Is there, and I'm going to stick with you, Maria, for this next question. What retail trends should investors in particular be paying attention to when and what are you kind of talking with them?
Well, I think I touched on this a little bit. So I think there is certainly discussion around converting some of the retail into other uses, right? So that's sort of a trend now, and but that's kind of aside. I think we see some of the strategies around converting retail into the fulfillment centers, and so that's a trend. And it's the retail-oriented manager that came to tell me about that strategy, sort of bringing the expertise of understanding and sourcing, having the sourcing capabilities of finding some of those maybe abandoned or semi-vacant retail boxes and converting them for the industrial use, and sort of, kind of like, and I believe that story because I think that they're quite capable of doing that type of conversion. So that's a trend. I think we talked about all the technology that comes into play right now, and how retail is so quickly adopting, and how that changes just your experience in shopping. And maybe the last one, again, related to the grocery delivery, but Amazon sort of rolling out, or that's what they tell us, right? That they will roll out in big quantities their concept for the grocery centers with no checkout lines, etc. So that's quite exciting. I think that's a trend. They'll probably need to either maybe use some of their footprint and some of their Whole Foods for that, or they probably need some more space, and who knows where they're going to find that space. That's a probably question to my panelists. Do they have a lot of conversations with Amazon around those fresh type of stores? So I guess lots of things.
Yeah, and I think these conversions and maybe other assets that might kind of blend retail and logistics are really interesting. I do have a question coming in though that says, how often are these conversions happening? Are entitlement issues and the fact that the sites aren't designed for these uses, does this make it hard to pull off? And I see you nodding, Kyle. Can you kind of talk a little bit? Maybe everyone will get a chance to kind of weigh in on this one.
Yeah, so over the last few years, we've spent a lot of time trying to determine what the viability of that particular strategy is. And then what we've discovered, it's doable, but on a very unpredictable scale. If you just look at the municipality from zoning purposes, they're going to take a retail tax base and eliminate it from the pool for an industrial use at a very different tax rate. And you're seeing a lot of municipalities who have been struggling financially, very reluctant to do so. That has been the biggest barrier that we've seen in being able to execute this strategy and say with any real conviction that it's scalable. And right now we do not believe that it is. In certain instances, you're able to execute it, but it's the needle in the haystack type situation.
Melinda?
We wrote a paper about this. So we kind of quantified all the different types of retail and estimated how much is in, markets that would actually be attractive for logistics. I think sometimes your struggling retail center would be in an area that isn't necessarily your best positioned for e-commerce distribution either. But also then when you start to whittle it down like Kyle did with design, with regulatory costs, and with just a big disconnect between value. In a lot of cases, you are taking a big haircut to convert, and that's going to continue to be a barrier. So we see it as a niche trend. We're hearing more about suburban office in the same way, but when you start to add those things up, it does really whittle down the number of really viable opportunities.
Jim, thoughts on this?
Yeah, agree. I think the only thing I would add is that it sounds exciting, it's challenging, it's difficult, and it takes a very long time to be able to pull it off. And so what happens is you really need an opportunistic level of return in order to take this type of risk on. And a lot of the buildings that make sense for this may or may not have encumbrances with respect to leases that need additional buyouts or patience in order to have these leases mature. And so it really can span a period of time that is not for everyone with respect to their holding periods or achievement of their goals. And so with that comes increased level of opportunity, cost, and need for return, and matching all of those things up with everything that was talked about with Melinda and Kyle, and your comments are great, about regulatory issues around these as well. Really puts it into a very small category. Everyone seems to talk about it. It sounds really exciting. It just really isn't a big basket of opportunity.
Yeah. Any final thoughts on this, Maria? You want to kind of get the last word?
No, I agree. It's exactly sounds very exciting, and as an additional upside, but I mentioned earlier that it needs to make sense on the risk return basis.
And can we talk a little bit about what investors in particular, and we've got a lot of investors in our audience, so it's great to kind of target it for them. Are there any trends on the logistics side that they should be aware of? And I'm actually going to start with you, Maria, because you talk to investors all the time. Do they have questions? I know you're here talking about retail, but I'm sure they ask you about.
I did not prepare that question.
They ask you anything? What are there any trends that they are asking you particularly about? And then I'll go to the rest of the panel.
I think maybe one observation I may sort of suggest here is that when I look at the industrial only strategy, right, I kind of have two ways to evaluate it. One, how much development is going to be taken on in the particular strategy versus just buying existing assets. So that's kind of one way I sort of bucket that strategy. Another way is how sort of focused it is in one segment of industrial versus being broad, and there are pluses and minuses in it. But I would say that cold storage is where I think there was a lot of discussions and continue to be such on the industrial side. Everybody gets it, the story. Everybody appreciates the operational complexities that come with that. Everybody wants to find, a few groups that they can commit capital to. So I think that's sort of the where I see interest from some of my colleagues wanting to understand the space better and find an investable option.
Thanks. Kyle, what kind of trends, when you're working with investors, what kind of trends and questions are kind of coming up, and what should they be aware of on the logistics side?
Yeah, I'd say one of the I guess trends that we're focused on now to really quantify the demand that's out there is, we've talked a couple different times of your stock supply or just in case inventory dramatically increasing to control goods to your customers. Is that an insurance policy that will live forevermore, and that becomes just a structural change to the supply chain? Or is it simply just a bit of a phenomenon as we sit here today with the disruption in the supply chain that people are forced to do that, which is causing the increase in more space? I think it's more of a structural change in our industry. but it's something that we've put a lot of resources behind to make sure that we fully understand that it's just not a snapshot in time right now that's creating this feverish demand. We're believers that it's more of a longer term trend, but it's something that I think everyone should go at and look at eyes wide open.
Jim, what should investors be aware of?
Yeah, I think the dominant one, without a doubt, is what Kyle talked about with this inventory rebuild. The pendulum has swung too far to the efficiency of these supply chains, and so we're going to have to find out: is it 5%? Is it 10%? Where is the comfort number with the resiliency of the supply chain? And it's going to be really a dominant feature. And I think it was something that maybe weren't all expecting pre-COVID. So that's the major theme. I mean, there's a couple other smaller themes. I think that cold storage, and Maria mentioned that, is something that's extremely interesting. It's a much more smaller subset of investable assets. The interesting thing about that is it's a high cost and sometimes tenant specific mandate. And so speculative construction with respect to cold storage is not as readily available, more built to suit than speculative construction, which makes it a different supply and demand metric. Of course, it's a different amount of tenancy that's looking for this, but it's an increasing component of what we're seeing. So cold storage is definitely interesting with regards to some alpha, over and above maybe some of the other logistics buildings. And then reverse logistics. And we haven't really talked about that, but e-commerce and the increased percentage of online sales just increases how many returns there are as well. And so not only are portions of buildings, but entire buildings or entire companies are basing their model around this reverse logistics or returns strategy. And it's an extremely inefficient way to store a product, right? So, when it goes out the door, it's very regimented and tracked very well with how the racking, the picking systems work. But when it comes back, it isn't. And so it's multiples of the amount of space on the returns, and the returns are an extremely high component of the sales. And so that's something that I think a lot of these tenants haven't really figured out yet on how to do it well or how to do it efficiently. And so, we see that a lot as incorporating into their leasing needs as well.
Reverse logistics, that's a real challenge. I know a truly staggering amount of clothing and other things bought online get returned. Melinda, are there any other trends that you think, or do you want to elaborate a little bit on these trends? I think cold storage, reverse logistics, what should investors be aware of?
I actually would offer something new, which is that the substitution effect for customers has decreased in a structural way. So one of the reasons why logistics vacancy has never gotten down to this level is because, a customer is willing to go down the road for a newer building, for a lower rent. What we see today, and it's been evolving through the cycle, and I think is on a much faster path than now, is that customers are willing to pay to be in the right place for their supply chain. So the importance of place, and they have more resources than ever to really connect the dots across their supply chain. So if you're not thinking about location strategy by lining up all of the inputs, the transportation network, where their end customers are, where the labor is, then you'll fall behind and not really be able to capture some of, the real rent growth is where we focus all the time. That comes from being in the place where customers really need to be.
And we're coming up toward the end of this panel, but I want to give everyone a chance to kind of share some sort of key thoughts and takeaways for our audience. And so I'll start with you, Maria, and then I'll go around to the whole panel, and just sort of what we've talked about today, and some of the things that you think are sort of key to walk away from this panel with. Any key thoughts or trends to be aware of?
I think I'm quite excited about 2022, actually, because I think that label of the winners and losers probably will start sort of disappearing a little bit in terms of the real estate sectors. I think each sector is going through evolution, and retail in particular, I think, has the momentum that it starts to pick up. So I'm quite excited to start maybe taking more meetings to learn how the sector is evolving. But at the same time, I mean, industrial is one of the favorites, and I don't see that going away anytime soon. But I'm excited to see how retail is going to evolve.
And Maria's got herself into trouble by saying she's excited to take meetings.
To learn.
Kyle, any final sort of key
Oh,
takeaways?
yeah, absolutely. So obviously it's been a fun time for I think everybody in the business. I think everybody's looking forward to getting back to a more in-person, frequent meetings. But at the same time, I think what we've learned through the pandemic is speed to market, nimble, fast-acting execution is crucial to any success, and that starts at lease formation to acquisition to capital formation. And with the rapid pace that we've seen these trends evolve, an investor, an LP, or an investment manager, developer, owner, operator, whoever it is, their speed to market is crucial to their success.
Jim, what kind of final thoughts or key takeaways might you have for our audience coming off of this discussion?
I think final thoughts is, look, we've all been talking about logistics a lot over the past couple of years, and I think it's a little fashionable to say that it's overextended. It's fashionable to just get exhausted of talking about it because there's not a lot of things that are happening that are exciting to talk about with respect to returns. And I think people are starting to creep into that, what other options are there, be a contrarian. I don't think it can last forever type of item. And that's great. That's okay. That's what we do as investors. But I think what you really have to do is continue to challenge yourself on the thesis and the underlying numbers. If there still is a supply and demand imbalance, if it's the huge demand that we're seeing that's going to continue, the supply chain fragility that's going to continue, lack of new supply, whatever it is that's leading to this rent growth and this performance, these are long-lived trends. It takes time to get to the point of normalcy and to the point of equilibrium. And so I know we've been talking about industrial for a few years here, and it's had a lot of good success. It doesn't mean that in the short or mid-term there can't be some continued success in alpha vis-a-vis other property types there. Of course, that doesn't mean, exclude the other types, retail or otherwise, to the detriment of your portfolio. But I think there's a little bit of exhaustion out there with regards to the discussion. But if you really look underneath the numbers, the thesis still holds.
And Melinda, what's your key takeaway here?
I mean, I think so much has already been said, but one thing I'm really excited about, and keep in mind we have a lot of customers that rely heavily on traditional retail too, is I think that there's so much innovation happening, whether it's on the front end and the customer experience in store, online, and all the back end supply chain movements that need to be in place to make this the best environment for your ultimate end customer. I think we're seeing a lot of change happen more quickly than ever. Yes, there's probably some exhaustion, but I think it's such a great opportunity going forward to really think holistically about how all these pieces fit together, how it might support outperformance in certain retail types, certainly in certain logistics locations. And it's great that we do have a strong and supportive economic backdrop, at least for the near term, to really think these things through and make some long-term decisions. So I would keep an eye on innovation. I would keep an eye on the integration between all the different property types, and really try to stay ahead of some of these mega trends that just seem to be happening more and more quickly.
Thank you. And I'd like to take a moment to just thank our panelists on our first panel, Kyle, Jim, Melinda, and Maria. Thank you so much for sharing your insights around both industrial and retail, the sort of macro trends driving them. We will, in the additional panels today, look in more detail at retail and then in more detail at the logistics segment. So thank you all, and thank you very much for being here.